All right, team. So this podcast is actually a recent webinar that we did with a Kiwi-based company for free of charge. Now, if you would like us to come into your workplace and talk about financial well-being, reach out via the link below. And remember that this podcast is actually best viewed on video.
So today we are talking about, Mike, what are we talking about today?
Growing your wealth, which is always a fun topic to talk about. And it's a really interesting time to be having these sorts of discussions because there are really two camps at the moment. You are holding on for dear life, or you have capital to deploy. And now is a good time to be trying to think about how to grow your wealth over time.
And the good thing with either scenario is it's going to be better, assuming you do something with the money if you've got something to deploy. For those with high interest rates, money and economies are weird things, Mike. Like you get excited that it is so bad because it means it's about to get better. And we are at the point where it's really bad and about to get better.
The thing I love about this particular point versus 2 weeks ago is that we had that first official cash rate drop. And so, yeah, I get it. It doesn't reflect instantly on people's situation. It was a tiny drop. It's a couple of dollars here and there. But what that means is a very clear indication that we are past the worst of it and we are getting to back to the good bit.
So today we're going to have some fun. You've given us some time on, what day of the week is it? Thursday? It's all kind of mushing together. Yeah, Thursday, lunchtime. Hopefully you've got some lunch. We're going to talk for maybe half an hour. We always say half an hour. It's always 40 minutes. Then we're going to do some Q&A. So everybody, if you've got questions as we go, pop them in the Q&A and we will answer them at the end. Let's jump into it, Ravi.
Cool. So 25% of you have heard about us before or seen one of our webinars. Look, both James and I work for Lighthouse Financial Services, and our mission is pretty clear. We are trying to secure Kiwis' financial future. And we believe in a couple of really key things, buying long-term assets and holding them, compounding returns is the most powerful force in the financial universe. But everything we believe in, our entire mission, comes down to a really easy equation. Education, which is what today is, plus action, which is not what today is, and then a little bit of time equals financial freedom. And that's where we're trying to get people. We're trying to get people to financial freedom. Now, you're going to hear us talking about taking action quite a bit today, because if this was the taking action bit, if all you had to do was listen to us talk for an hour, that would be beautiful. But it's not. This is the education piece. You don't have to swing for the fences. You don't need to buy 15 investment properties. Doing things like a budget, reviewing your spending, making a proactive choice about your KiwiSaver provider, all really easy things that can make a huge difference down the line.
Yeah, small, consistent steps. You start with the smallest thing and build from there.
Yeah, cool. So here's a bit of our vanity slide for those who don't know us, as to why you should listen to us. We've taken about 8,000 Kiwis through these webinars or events. 95% said they'd recommend us. The 5% don't know. Maybe they're not into us. I don't care. We've worked with some pretty headline companies: Samsung, Rocket Lab, Xero, WSP. But it's just a bit of a vanity slide to say, we know what we're talking about. We've done this before. Really, though, where people get the most value out of this is the questions. So when we're going through this, keep thinking about questions, start putting questions in the Q&A function. Try not to put them in the chat. If they go in Q&A, they're anonymous, which means people can ask a lot better questions when they know their name isn't getting broadcast with it as well. Cool. But when we are talking about these questions and when we're talking about the advice that we're talking about today, we are just talking in general terms. We are not giving you personalized financial advice. Both James and I are financial advisors. So we have to be very careful about what we say and how we say it. If you ask us questions like, hey, I'm 30, my partner's 32, I earn X, they earn Y, what KiwiSaver fund should I be in? What property should I buy? Should I do this? That is personalized financial advice. We can't do that on this call. We will get it wrong or it won't be accurate enough, and it's just not the forum to do it. So feel free to book in a time with us. There'll be some links that come out after this. You can sit down, have a chat to us if you do have any personalized questions.
But also, Milford Aggressive Fund, $800,000 purchase price in Tier 2 Peninsula.
We will get very close to giving personalized financial advice.
This is recorded. I also saw somebody has an AI tracker on this thing as well, Mike. So be careful.
Okay, cool.
So let me jump in and give you a little bit of a break there, Mike. So this is our agenda for the day. So like Mike said, people like to jump straight to the fun stuff, setting up businesses, buying property, contributing to shares, derivatives trading, all this stuff. The big thing, you have to get your foundations right before you do anything. Why? Because your income is your biggest asset. If you do not manage your money well, you will not have surplus cash to deploy over and over and over. The second, if you do not have a good emergency fund, then life will go wrong. You will spiral into bad debts. But once we've got that, we will talk a lot about property today, investment property, purchasing your own home, contributing to managed funds, and then, in terms of long-term financial freedom. I do want to talk a little bit about the goal setting bit, Mike. You talked about just before around what is like a small step. Everybody's come here for a reason. What is the smallest step you can take in the right direction? A really, really good one is writing down your goals. And if you've got a spouse, look, probably like 9 out of 10 couples I talk to, they've got different money personalities. They fight about their money. And you don't want to get home at the end of the night. You don't want to have those conversations, but you need to get on the same page in terms of your money and what you're trying to do. So you need to go, what are the things we want now? So what is the lifestyle we're trying to achieve now? Are we tracking it well? Are we staying on top of it? And what do we want for our future self? Because the whole thing is a big balancing act. You might be really, enjoying yourself in the moment, not looking at anybody in particular, Mike, but living their best life in the moment. But future Mike might be in a little bit of trouble. The other thing that happens, particularly with engineers, is there might be a couple of Scrooge McDucks out there who are planning for future them, but they're never going to be any younger than they are right now. Their kids might be at an age where they're not like moody teenagers. They might still like you. Having that enjoyment along the way, having those experiences. So the whole thing is a big balancing act between current you and future you. And if you go, I don't really know where to start with my goals, let me tell you, there's only 4 things anybody wants. Write them down. The current lifestyle you want, okay? So what do we want to do right now? Do we enjoy our current lifestyle? Are we traveling? What are the things we do? And write down what that means. Are we spending 50,000, 100,000, 150,000 a year, whatever it might be? Current life, a future lifestyle. What does that look like? When are we going to retire? Do we want to push really hard for an early retirement, or are we happy to work longer? Do we want to work part-time? What does that look like? The house we live in. Do we want to stay in our current home? Do we want to upgrade? If you upgrade, you're going to have to work longer because you've got Mike giving you more debt and you got to pay it off. And the last one, if you've got kids, is your kids. So a lot of people want to give their kids a head start. If you've got kids still in the household, imagine how bloody expensive it's going to be to buy a house when they want to buy one. So a lot of people want to give their kids a head start.
All right. So budgeting. Now, budgeting gets a pretty bad rap, right? No one likes being told you can't have fun. You can't do this. You're spending too much. You've got to pull back on this. It's like being told off all the time. This is not what budgeting is about. Budgeting is pretty simple, right? You have some income coming in, you have some expenses going out, you have a bit of fun, and then you have your savings. Well, that is the wrong way to look at it. What we really need to do is rewind back to those goals that James talked about and go, cool. Let's say I have, my goal is to buy my first house and I need to save an additional 50,000. Now we're starting down the right track of budgeting and setting those kind of budgeting linked with the goals. Now, when we're looking at budgeting, and again, it's not a fun thing to do. We are really simple fans of keeping things automated. So making sure that actually when you are getting paid, everything is just falling into some like accounts. All of the automatic payments are set up. You're not interacting with it. It really is something you don't want to be spending a lot of time on. Your budget takes a little bit of time to plan, but then you're only spending 5 minutes a week managing it, making sure that, yep, everything's gone into the right place and everything's getting paid. The really key thing to remember with your budget though, is your savings point or the amount you're savings is the only bit that's getting you ahead, right? Your expenses, you got to spend it. Fun, yeah, well, you got to have some, but if you have too much, like you said, that balance is going to get out of kilter. Future you is going to be in trouble. That savings bit is the only bit that's going to get you to financial freedom. And savings for you might not look like putting money in a savings account. It may be paying your mortgage off earlier. It may be contributing a little bit more to KiwiSaver, but that is the piece that's going to be getting you ahead.
And sorry, Mike. When it comes to the budget, just to emphasize it, like if you don't have a surplus, you are going nowhere. And you might go, it's a cost of living crisis. We've got 7% interest rates. Newsflash, cost of living crisis is not going to last forever. Inflation is coming down. Interest rates on the mortgage will come down, which Mike will talk about. It's about what is within your control. But if you are not saving any of your income, these goals you've got are going to be very, very hard to achieve. Income is your biggest asset. Make sure you use it wisely.
Yeah, but the thing we need to stress here is that income isn't everything, right? We have customers who earn over $1 million per year, and they are going backwards every fortnight because they cannot budget. If you can't budget 50 grand, you can't budget 500 grand. We see it all the time with our customers. Humans are fundamentally the same, right? You're looking for short-term gratification. More money means more things quickly. The budget is the thing that's going to protect you from that.
So there's lots of different ways to budget. We're talking to a lot of engineers on this call. I'm sure there will be those that have a spreadsheet that will have some forecasting and will be quite technical. If you need tips on how to budget, like Mike said, we love automatic payments. So this is how we structure bank accounts. So the first one is fixed expenses. What percentage of your income goes towards fixed expenses? You might go, James, what's a good rule? Well, it depends. Are you a single mum versus are you living with your parents? So the percentage of discretionary income is completely different from situation to situation. But what percentage of your fixed expenses do you have? And then it goes into that account, and then it should all be automated on the backside so you never have to touch it. Next, the emergency fund. So life is going to go wrong at some point. I'm sure it's happened to everybody on this call. If you do not have money set aside, you are going to use high interest bad debts that are going to be very hard to get themselves out of. Then what happens after that? Some people, maybe Michael, maybe not, jumps to the fund and go, I want to buy myself some great new clothes so I'm feeling good about myself. But we're not going to jump to that fund, that jar. We're going to jump to the savings jar and go, based off my goals, how much do I need to save? How much is the dollar figure around my goal, and then reverse engineering it and go, what is the step I need to take each fortnight or each month when I get paid to make sure I'm on track to achieve that goal? Then you have some money allocated to fun and you go and live your best life.
All right. So we've talked about the budgeting. Everyone's rolled their eyes. I get it. And we used to actually tailor these slides, like the budgeting slides, to the group that we were talking to. And over our 8,000 people that we've taken through these and all the presentations, we've come to realize that everyone basically treats their budgeting the exact same way. Everyone is just as bad as budgeting as everyone else. So it is really important to focus on. I know it's not sexy. It's not fun. You're never going to be at the barbecue. Someone's going to be talking about, I invested in Sharesies and it went up by this much. You're going to say, well, I just did my budget today and I've reduced my spending by 10%. It's like, it's not a sexy thing to talk about, but fundamentally, it's the foundation of the house, right? If the foundation isn't right, everything else is falling over.
That's the barbecues I want to be at, Mike. The budget check barbecues.
Yeah. That's why we don't get invited, James. No, cool. Hey guys, so debt is a really fundamental thing, right? So you can use debt in different ways. Now, we want to talk about good debt versus bad debt because the whole point of this webinar is how to grow your wealth over time. So first off, we've looked at the foundation, which is around, making sure your budget and your goals are right. The next piece is around using debt to leverage yourself up to make sure that you are earning as much as possible in terms of capital gains or returns. So fundamentally, we have to start with two things. What are the different types of debt? We have bad debt and we have good debt. Now, I don't need to talk through afterpaying credit cards and car loans. We all know they're bad debt. Sometimes you need a car, you go get a loan for it. But everyone who emails me and says, Mike, I want to buy this new Tesla. The banks are giving out cheap money for it. They say it's 1% interest for 5 years. You don't need a Tesla, right? You need a car. So you've got to understand that is a want and that is a bad debt. And you should be clearing that as quick as possible if you want to go out and get a Tesla. Now, you'll see here that I've got owner-occupied mortgage on the bad debt side of the ledger. Buying your first property, getting on the property ladder is a fundamental key and an amazing kind of step you can take or strategy to grow your wealth over time. That is tried and true in New Zealand. I don't need to go into it, right? Everyone's seen the capital gains over the long term. And I'm not talking about 2021, 2020, 2022 capital gains, just the long-term average, that slow, consistent building. As soon as you take out an investment property debt or an investment property loan to go buy an investment property, instantly that becomes bad debt. You want to clear that debt as quick as you can, right? So you, generally speaking, we advise people to put their investment properties on interest only, and you are focusing on hammering that owner-occupied debt as quick as you can. The other reason that this may become bad debt is you go, look, my buddy at work, he lives in this area, so I want to live in this area. That area is more expensive. I don't need to upgrade my house. I just want to be somewhere else. And I go and upgrade and spend more money on it. It means you're spending longer paying off a mortgage for basically the same box that you live in. Now, I'm not saying don't do that, but you have to think about the implications of that long term. And if doing that is going to impact your future goals and your, the life you want to live in the future come retirement. So again, the good debt side of the ledger, investment property debt. You are making money off that is basically a business loan. Business debt, if you are investing in a business, starting a business, buying shares in a business, that is good debt because you are earning money off it. Student loans. Student loans are good debt to a point, but then they become bad debt. Now, I don't know who's on the call, but if you have 3 doctorate degrees in philosophy, I'm going to say that's probably bad debt. A practical student loan for something that you're going to use in your career is a good thing. We know over time, in the second half of their career, people who have degrees definitely earn more than people that don't. But again, like any debt, if you just take it for a ride, don't treat it seriously, it ends up being bad debt.
I think the other thing, Mike, with this as well, in theory, all the good debts can be bad debts as well. So like a really good example with investment properties is in 2021, everybody wanted more at 2% interest rates. And then they didn't realize interest rates could go to 7% and then got themselves in a world of pain. Business debt that's not used well can also be bad debt. But on the flip side, and Mike, it might be good for you to comment on this, there's people who are scared of good debts and go, I don't like to see the debts in my name. But that can also result in substantial opportunity cost, right?
Yeah, the taking action piece is critical. And to be honest, time fixes most bad decisions with investments. Not all of them, but most of them, right? So, we know a lot of people who are very smart, who should be a lot richer than they are because they spend a lot of time analyzing things, looking for the best moment to buy, the absolute best opportunity. We know a lot of other people who are maybe of more average intelligence, who love pulling the trigger. And like over time, they end up being better off because, they don't blindly jump into things, but they go, I know enough about this. I'm comfortable with the risk. I understand there's, we're probably not going to get a better opportunity. So they just jump in and do it, right? So, there's something to be said for just pulling the trigger and taking action.
Mike, you've got that great analogy about that Ponsonby Villa. Do you just want to share that one?
I love this, right? Do you think it mattered if your grandparents, back in 1950, whatever, 1920, waited 6 more months until the price of that villa or that ex-state house in Ponsonby was, instead of being $600, it was $500 or $550 or not $1,000, but $900. It doesn't matter, right? It's a $4 million property now. Time fixes most bad investment decisions, and people struggle to think about compounding returns, right? Humans struggle with log functions. They can't get it.
Humans struggle with log functions. We are talking to engineers though, so maybe they do. Yeah. And that's the exact same thing when it comes to, like, people go, oh, that time has passed. We won't get those returns going forward. Property will continue to double over 10 years. Share market will continue to do 10% a year going forward. Those things will continue to happen.
Cool. So now that we've got in a sense of what is good debt, what is bad debt, that owner-occupied debt, you've got to pay it off as quickly as you can. And here's a really good illustration of what I mean by people not thinking over the long term. Let's say you've got a $600,000 mortgage, long-term interest rate around 6%. Over 30 years, your minimum weekly payment's around $830. Let's say you contributed an extra $200 per week over that same time period. You are going to pay that loan off 11 years faster. Now, you might be going, Mike, cost of living crisis. I don't have, $200 a week to pay it off. That's not the point here. If it's $50, if it's $400, if it's whatever you can kind of contribute that's more to make sure that that loan gets paid off earlier, that is the key thing.
And interest rates right now, a lot of people are seeing like 7%. By the end of next year, it's very plausible that you might be like at a 5% interest rate. And then cost of living, right? You think about the pay rises you've been getting, and all of that's been going towards like groceries being more expensive. Cost of living is the rate it's growing at is dropping substantially. Inflation was 7%, it's now like 3.4. And you can tell from the lead indicators it's going to come down again because there's so much pain. So you are going to have more discretionary income in the future. And it's incredibly important, opposed to those people who aren't on this webinar, who are just going to spend it on holidays and living their best life, that you guys are, having some fun, but also being a bit responsible.
Yeah. Cool. So let's say that you take those minimum contributions and, you just pay the loan off over 30 years. In 30 years, you're going to be debt free. Now, before when I said you're going to pay it off, 11 years quicker, you might go, Mike, that's great. What does it matter for me? Let's say you took those contributions and you invested them over 10 years. You're going to have $653,000 sitting in an investment, right? Well, there or thereabouts based on some math. So it's not about just paying the mortgage off earlier. It's then, what do I have left over? And we call it the sprint, where you're still working, but your mortgage is gone. And it's, what do I do with that money then?
Yeah, I mean, for those on the call, think about what percentage of your income goes towards your mortgage, and you have that cash to go and do something with. Okay, so Mike spoke about paralysis by analysis and like not taking action. The other piece is we all live very busy lives between work and hobbies and family, that it's very hard to prioritize our money. Now, we've got a study from the year 2000 to the year 2020, where you have $2,000 to invest every year into the S&P 500, which is the top 500 companies in the US, with 5 different investing styles. So Mike, let's go one for one explaining the styles.
All right. So first one, Peter Perfect. He picks the best day every year to put his $2,000 into the market. So lowest closing point in the market, impossible.
Ashley Action does not muck around. Whoa, Robbie, you're getting a little bit ahead of ourselves with the poll results. Ashley Action does not muck around. Invest $2,000 on the first trading day of the year.
Matthew Monthly, so divides his $2,000 into 12 portions, puts it in at the start of the month. That's dollar cost averaging. It's essentially what you're doing with your KiwiSaver.
Rosie Rotten is just as unlikely as Peter Perfect. She is picking the highest point each year, which is obviously the worst point to invest.
Equally as impossible. And then we have Larry Linger. Larry keeps all his money in cash, maybe runs another spreadsheet, maybe does some more analysis, thinks there'll be a better time to put it in, never gets around to investing in the market. Who do you think has the best outcome at the end of their investments? Now, I always find this fascinating as to who picks what and why they pick it. It's usually pretty consistent. Let's see how we go with this one. There's not a trick question. Peter Perfect, who is a perfect investor, has the best outcome. But that is impossible. That is not what we're focusing on here. The real value in what we're discussing is everyone to the right of that. James, run us through it.
Yeah, so there's some that aren't that impressive, like say Ashley Action, dollar cost averaging. If you invest the first day every month for 20 years, it's pretty much dollar cost averaging. They're about 15 grand behind Old Mate Pete. The interesting ones are the last two. So Rosie Rotten has invested the worst time every year for 20 years in a row, and she is still only $30,000 behind Peter Perfect, and more than 3 times better off than Larry Linger. And the reason for this is the exact same analogy that Mike gave before with that Ponsonby Villa, and it's the exact same with the share market. If you invest at a horrible time, as long as you are diversified, time fixes all bad decisions. And it's the exact same thing for those people that bought property in 2021. If you give it enough time, people will look back and go, wow, weren't you lucky to buy a property at that point?
Yeah, and I really want us to focus on Larry Linger here, right? Like, again, when I said before, we know a lot of really smart people who don't take action, and a lot of people who should be, who take a lot of action and maybe aren't as smart. Just getting on and doing something, taking some action. We're not saying you have to bank the money on the S&P 500. If you are just paying off your mortgage a little bit more, getting your budget sorted, making an active choice about your KiwiSaver, you could rip all of that off in about, I don't know, half an hour. Like if you really wanted to, have a quick, feed all of your transactions through PocketSmith, That probably takes you 15 minutes. Have a look at your KiwiSaver provider, make a proactive choice. Like, these are really quick things to do, and they can set you up hugely over the long term.
And that is what opportunity cost really looks like. So there is risk making investments. There is a lot of risk not making the investments. And that is what Larry Linger shows. He has to save 3 times as much money to be in the same position.
Yeah.
Okay, so the oldest debate, Mike, shares versus property. So we always get asked, which one should we invest into? So in this debate, I will represent shares. You will represent the evil property investors. So let me talk to you about shares first, Mike. $140,000 invested, make a 6% return, less fees and less tax, and substantially diversified into thousands of different companies in different countries and different industries. Beat that.
Easy. So property, same $140,000 gets us a $700,000 investment, right? You have already used the power of leverage. You're taking not much of your money and a lot of the bank's money to buy an investment. And the real power of leverage with property, and some people be on the call saying, well, I can leverage my stock portfolio on my Forex. Your chance of getting stopped out is so much higher in the share market than it is in the property market, right? So you get a 5% real return minus $15,000 of additional cost per year, maintenance, rates, et cetera, et cetera. This is hands down for me a clear winner to property. Ravi, oh, would you look at that? James, the numbers are what the numbers are. What are you going to say?
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
I to argue, Michael, it's like I've never seen this pack before. I didn't see this coming. So as you can see, properties at $20,000 a year, and that's the capital gains less the cost. Shares are about $8,400. Now, despite that, it is not that everybody should have property. So property is a great tool for those who are working and have good income, surplus income, and can buy a property, hold it over a long period of time. However, Michael, you can't sell a bedroom to go on a holiday. Property will make you rich on paper, but is quite crappy in terms of cash flow. That's where shares are really good. So really well diversified than having some dirt in a small island nation, and the ability to be more liquid, pay you an income, and also erode your capital over time. So the general rule is property is great while you are working and growing your wealth. Shares are really useful when you are looking to receive an income.
Yeah. Cool. So I've talked about this a couple of times, right? And this is really where the power of property kind of outstrips shares, especially over time. So, it is the power to use some of your cash or all of the bank's money to go and buy an asset. We call that leverage, and then to go out and just sit on that. And the returns you get are not on your initial investment. They are on the leverage, like purchase price or value of the asset, right? So how do we do this? Let's say we've got an owner-occupied property and you can lend to 80% of that. It's normal bank policy. So you can lend $800,000. That is the maximum you can lend against that property. Let's say you have a mortgage balance of $600,000. That gives you $200,000 of usable equity, where you can go back to the bank and say, hey, I want to turn this into an investment property. Can I go use that money to buy another asset? You can lend more. You can lend more than 80% actually on an investment property with the main bank. But just for this illustration, you can take that $200,000 and turn it into $1 million investment. And that is how you use property to leverage up to keep buying more. Now, it looks great on paper. It's not as easy as this. You have to go get bank approval. You have to be able to afford it. You have to find the right asset. There's a lot of stuff that goes into it. But fundamentally, when you see people saying, oh, yep, I've got 6 investment properties, or I've got 3 investment properties, or I've just bought an investment property, this is usually how they've done it.
And investment property is very unpopular right now because prices have gone down and interest rates are high, but we are only at a point of time. I want to do a plug for the Q&A. So we've got quite a few questions in there that we will answer. But Mike, I do want to answer one of them now because I think it's a good time where we're talking about leverage. Can you explain a little more about investment property versus owner-occupied mortgage and the need to pay the owner-occupied mortgage down as fast as possible while leaving the investment property mortgage interest only? If you have both of these mortgages, does it make a difference between which one gets paid off first as it's all coming from the same pot?
Yeah, so it does matter which one you pay off first. Generally speaking, your investment property debt has better tax treatment than your owner-occupied debt. So you'll be in a slightly better tax position if you leave your investment property debt there longer over your owner-occupied debt. But really, it is about, at the end of the day, you don't want to have debt left on your house when you are heading into retirement, right? You want to have an asset that is completely freehold, your house, as you're shifting into retirement, because you don't want to be paying a mortgage when you're not working. So we need to be paying that debt off and clearing it. It's bad debt because it's not making you any money. And some people will think, oh, but the capital gains I'm getting on my owner-occupied house, that's making me money. It's making you money on paper. Like James said, you can't sell a bedroom to go on holiday. You have to sell the entire house. So unless you are camping on your front lawn or you're selling the house, there's no real kind of money there. It's just a wealth on paper. That investment property debt, that is where you have the ability to sell it, to rent it out, to do kind of other develop it. You can do things with it. So that's why we say the tax treatment, and also you don't want debt hanging around on your owner-occupied property as you move into retirement. It means you should leave your investment property debt there and pay off your owner-occupied debt first. Once you have paid off that debt, you can then start on the investment property debt.
If I just gave an example with $1 million mortgage on an investment property, the tax benefit is say 6%, you're paying $60,000 a year in interest, 33% tax rate. It's about $20,000 a year in tax benefit by holding that debt and focusing on the owner-occupied debt, which has no tax benefits. Okay, so we're quickly going to touch on some more kind of fundamentals. So we spoke about an emergency fund. We recommend you have 3 to 6 months of expenses set aside. Short-term goals, if you want to, we have a lot of people who invest into Sharesies and Hatch and all different types of things, and they want to use the money short-term. If it's within 3 years, it should stay in cash. If you're investing for, investing for the long term, we know the outcome will be like 10% in shares, 6% in property. But if you're investing for short periods of time, that is called gambling. Important that you have a will because you want your assets to go to the right people, and insurances. So health insurance, to give you an idea, the average wait time for the most common surgery is like 180 days and it costs $20,000. So, it's a big impact and those lists are getting longer. If you've got people dependent on you, life insurance is a lump sum to make sure that, your loved ones are looked after. And income protection, your income is your biggest asset. If you don't have your income, you're more or less screwed. So it's important you insure it. I have people say to me, James, we're just not insurance people. I don't know what the hell that means. You don't get to choose whether you die or get sick, depending on your lifestyle. You've got to make sure you've got those things sorted. And when it comes to financial planning, which is what, all the stuff we're doing and what I do in the wealth team every day. The other thing that happens is, on the accountability side, you need to have some sort of documentation and somebody keeping you accountable. That could be a financial advisor, it could be a spouse, it could be a friend, that works. But the reality is, and you need to make sure you've got a healthy relationship with money, is we expect it to be a straight line. But the reality is more like the line below, because good things happen, bad things happen, and it's about being consistent. And I say to people, if you've got a plan with clear steps, you'll get to the destination. Just the way you get to the destination looks a little bit different.
It's all about, when we're looking at making decisions, you make decisions over the long term or the short term. And a lot of what we do with our financial plans is just telling people no. I realize the market has dropped 20% or 15%. You don't need to change your KiwiSaver fund. Nope, you don't need to go out and buy gold. Nope, you don't need to go out and buy silver. It's people often make decisions on a short term of what the media is feeding them, right? You are always going to see negative things in the media. It's a really tough thing for us to manage with people because people want to be active. You want to feel like you're doing something all the time to make yourself better off. So again, the accountability piece might be a financial advisor. If it is your partner, you want to make sure you've got a really good relationship with money and the ability to communicate around money, because money is a taboo subject. Kiwis do not like talking about money, and no one wants to go home at the end of a long day of work and start a fight about money with their partner, right? You just don't want to do it. So for a lot of people, having a financial advisor is a way that you can kind of mediate those conversations.
Cool, which does bring us to our quick plugs before we do Q&A. So if you do want some help in terms of a financial plan, so we charge a fee for a financial plan, but that's great because you know how we're getting paid, and it's not like what's happening with these guys, are they recommending us the right stuff? So that is about setting goals, working through those foundations we spoke about, and then working out the right investment strategy with the right projections off the back of it. We can also help with KiwiSaver, insurances, etc. And you might just have some questions about your own situation. We're happy to have a chat and steer you in the right direction.
Cool. And if you want to talk to the mortgage team, there'll be a link coming out. You can scan that QR code. At the moment, there is a lot of change in the market, right? We are getting the official cash rate cutting, which means interest rates will start to come down. Some of those bank rates are looking really good at the moment, but boy, oh boy, going for the long ones could really hurt you over the long term. So at the moment, I'm asking people if they're thinking about refixing their mortgages to come have a chat with us. Just make sure you get the right advice. It could cost you tens of thousands of dollars on your mortgage if you pick the wrong rate at the moment. Other things we can talk to you about, how much you might be able to borrow if you want to get on the ladder. We can get you a pre-approval. I can give you advice on specific properties, your first home, next home, investment properties. Structuring and refixing, like I just sort of said, about and what is the best interest rate for you at the moment. The lowest interest rate is not always the best interest rate. And that is definitely true in the market at the moment. Well, that's not personalized financial advice.
Why do you say that, Mike?
Because at the moment, like if you think about where we are in the interest rate cycle, we're past the top and we're coming down. Some of those 5, 4, 3-year fixed interest rates, they got a 5 in front of them, right? So you're looking 6.85 versus 5.9, 5.7, 5.6. That looks like a really sharp rate at the moment. Literally in 12 months, 24 months, that is going to look like a horrible interest rate. And you are going to be stuck on that rate because the break costs to break out of it will mean it's prohibitive. It's not worth breaking that loan to go onto a lower interest rate. Again, that is not the case for every single person. There may be things in your situation which means I need budgeting stability. I need to fix for a longer term. That's fine. I still recommend talking to a mortgage broker over a banker. It doesn't have to be me. Chat to your broker or a good broker, about what you should do.
I had a client fix for 18 months this morning, and I said to them, you went directly to the bank, didn't you? And they're like, yep. Yeah. And then you might go, geez, looks like these guys spend a lot of time talking about money. We do. We have a podcast, Checks and Balances. 3 episodes go up a week, about 45,000 downloads a month. So if you want to continue to educate yourself, Ravi will pop some links in the chat. Let's get into Q&A. I can see some questions going in the chat instead of the Q&A. So if we can just make sure we pop those in the Q&A. Let's start at the top. Mike, with capital of 20K to 40K, what's the best way to invest?
I love this question because we are straight off the bat. I don't even know your name, and you're asking me for personalized financial advice. You might be 20, you might be 30, you might be 70. I have no idea. I have no idea what your goals are. I don't know what you want to achieve. I don't know what the capital is. I don't know how you got it. Is there going to be any more? There is no way I can answer this question. There isn't enough information. You need to book in and have a chat to someone.
Cool. Next one. Can you comment on the pros and cons of index-linked versus managed KiwiSavers? Yeah, sure. So the data says that you need to be very conscious of your fees when it comes to your KiwiSaver. There are very passive KiwiSavers that are low cost. Examples in New Zealand would be Simplicity and Kernel. But on the flip side, there are providers like Milford who have a higher fee, and their performance after fees, while all the data says that they shouldn't be performing above benchmark, they continue to do so. So that's where like it's a question of like, is socially responsible important to you? You might be like an avid, like I believe in low fees. You might like the ideas of Milford. You might want access to ongoing advice. It depends on what's the right thing for you.
Yeah, the next questions lead straight into that, right? So I'm happy with my KiwiSaver returns, but I realized some of my managed funds invest in mining and other assets which are linked with environmental and social harm. What are my options for ethical funds?
Yeah, there's probably two main ones in New Zealand. Booster has a socially responsible set of funds, and Pathfinder is the other one. Okay.
How much different would my emergency fund look if you have income or mortgage protection insurance?
Yeah, it's a really good question. So the question is, so if you don't have income protection, how big should your emergency fund be? Infinite is really the answer, because you might be having to have an emergency for until age 65. And if you tell me that doesn't happen, I spoke to a 33-year-old yesterday, single mum, husband just passed away from bowel cancer. So like bad stuff does happen to people. If you do have an emergency fund, one of the benefits if you've got insurance is you can have a longer waiting period for the insurance, which does make it a bit more cost effective. But our general rule is 3 to 6 months. If you're in more of a contracting role, then you should have a larger emergency fund.
Cool. Next one I love, because we get asked this in some way, shape, or form in every single webinar we do. Is it better to pay an extra $200 a week on my owner-occupied home, or putting that money into shares every week? This is the least sexy advice you're going to hear. Not advice, information you're going to hear all day. Pay off your owner-occupied home is usually the right way to go. It's very difficult to outperform a real interest rate, especially when they are 6-7%, with a headline return on a stock. Like let's say you get an 8% return, you're comparing a gross return with a net cost or a real cost. So you need to take off, tax, fees, transaction costs, depreciation, because you're not spending the money straight away. So very quickly, the interest rate that you're paying on your mortgage is usually higher than the return that you get from the shares.
Yeah, do not invest into shares if you have.
And if you're thinking, I'm going to do it through my Sharesies account, think again.
Yeah, do not invest into direct stocks. Just invest into some diversified, relatively low-cost funds. Next question. Is an owner-occupied mortgage still considered bad debt in comparison to the cost of renting a comparable house long-term?
So should I get on the property ladder or should I rent?
Yeah, I think it's because of the whole like owner-occupied being in the bad debt column.
No, you should. An owner-occupied property is a lot easier for people to grow their wealth with as a base than if they don't and they just rent, or if they are renting and buying rentals. And that's from a lending perspective. You get capped out a lot quicker if you don't have an owner-occupied home. And effectively, I mean, there's some other positives, right? You've more security, you long-term, you're not worried about shifting house all the time, but fundamentally you usually get capped out a lot quicker with your lending if you don't have an owner-occupied house.
Oh, okay. Next one. Will this recording be made available? Yep, we'll send it out afterwards. Next question. Mike, what is PocketSmith?
Yeah, so I mentioned PocketSmith to do a budgeting. So PocketSmith is an app that links to all your bank accounts. You categorize your expenses, and then it tracks your expenses. Now, again, you can do your budgeting on a spreadsheet, but you can lie to a spreadsheet. It is very difficult to lie to PocketSmith. They will categorize everything you spent, package it up, and deliver that back to you at the end of the month. Definitely a good app. I think they're Dunedin-based. Check them out. We really like them.
I explain it as great and terrifying. Mike, really good question for you. Do you think residential property will be as effective for value growth over the next 20 years as the last 20 years once the DTI, which is debt to income ratios, come in? And is there a confirmed date that DTI will apply from?
Debt to income ratios are already in place. They've been in place softly in the background at banks for a long, long time. So nothing too much is changing there. And they're around that 6-7 times is pretty, basically where they were already sitting. Do I think debt to income ratio is going to have an impact on house growth? Hard to tell, maybe. Whether it does or it doesn't, I think that property will still be an effective form of value growth over the next 20 years. The reason why the debt to income ratios may not have so much of an impact as you think is we import a lot of people into the country, a lot of immigration into the country. We do not build enough houses for our basically population growth. We're going backwards every year. And simple supply and demand generally means that the price is going to increase. There's also ways to get around debt to income ratios. You start at a second tier lender and then bounce back to a main tier lender because they're exempt from dollar for dollar refinances. So they don't really mean too much to serious investors. Yeah.
Cool, Mike, we have 25 questions, so let's do some fire answers. Next one, does leaving the investment property mortgage as interest only still holds true even when the interest repayments are non-tax deductible like it has been recently?
Yeah, I would say so. You still want to focus on clearing your owner occupied debt first. If for no other reason, you can generally lend more against that owner occupied property so you can leverage up to go again.
Cool. Next one. Have you got any concrete tips around budgeting? I've done some spreadsheets before, but don't know how to track them well. And grocery expenses particularly are just out of this world. So we put a link to a 20-minute podcast talking just about budgeting. Make sure to check that out. The main thing I would say is just make sure if you've got a budget you've written down and assuming there's some surplus, the thing that is not happening is that you're not sticking to it. So either it was never realistic in the first place or you're not sticking to it. If you're struggling to stick to it, more automatic payments, build a system around yourself so it increases your probability to be successful. Obviously, the very well-known saying, we don't rise to our goals, we fall to our processes. Next
how do I morally grow my wealth given the growing equality gap and collapse of the planet's life support systems? Is there a way to ensure your investments not destroying the planet and creating poverty for others? James.
Yeah, look, probably a little bit deep for me on a Thursday. So I'd probably say two things. One is there is the argument around property. It is a very flawed argument because there is always going to be a percentage of those who are going to rent. And I think realistically, property is just going to become more and more expensive over time. In other parts of the world, it's very common to rent your whole life. So we need good landlords in New Zealand. The second thing I would say is if you want to invest into like the share market in a socially responsible way, like I said, Pathfinder in particular, they've got some very cool stuff in terms of how they invest that improves the planet. So they would be my comments.
Cool. Any comment on the ethics of property investment, outbidding first-time buyers, etc.? We just touched on that. In terms of property investors outbidding first-home buyers, to be honest, I see that as more of a supply and demand issue. If there was, and again, your property investors generally don't outbid first-time buyers because what happens is property investors will have numbers that cap them out, whereas first-home buyers have, I love this property. So although you might see in the media property investors outbidding first-home buyers, that doesn't usually happen. Maybe in like 2021 at the very peak of the market, but that is not a typical market. Cash was too cheap. Yeah.
Cool. Next question. Do you have an indication for the standard fee for a wealth plan? Yep, it's roughly 2,000 plus just. If you do nothing with it, it's a complete waste of money. If you do something with it, it's the best money you'll ever spend.
Cool. How about commercial property investment? Is that similar at all to residential investment? Don't go near it. Like just you
Don't start there.
Okay. It's not similar to residential investment. Yeah, it's a box on the ground that people operate a business out of it.
That's too technical for me, Mike. Can you
basically where the similarities stop? Commercial property investment looks better because you get a higher yield and you have less costs, but yeah, the capital gains are not as evenly distributed in commercial property as they are in residential properties. Commercial property depends on the tenant, the location, the property type, is it specialty? Then you've got to think about the earthquake strengthening the building, MPS rating. There's a whole lot of stuff. It's like I tell people to stay away from it unless you are a serious property investor who has done their dash in the resi market.
Cool.
Can you give some advice for managed funds? Growth, conservative, once managed fund found or two to have backup. Managed found with a portfolio and properties, managed fund. James?
In the first one, there's one managed fund or two to have a backup in case the first one falls over. So like the question before, it really depends on your, where you are in terms of, if you've got a really long time frame, of course, like a more aggressive fund will deliver better returns. Can you tolerate the risk? Do you have the time frame? The idea of having multiple managed funds is really coming from an emotional place instead of a logical place, because if you are invested into like 1,000 companies, that's very well diversified.
Does Lighthouse consider crypto, Bitcoin in particular, in diversification? And then that question's at 112, at 113. What's your stance on Bitcoin as a long-term investment? So we'll double up.
Cool. The Lighthouse view is to the moon. No, I'm joking. It is, we don't have a view. So like essentially when we're giving advice, especially for those who maybe don't have great financial literacy, we need to have confidence in terms of long-term averages. And how the hell do you do a long-term average for Bitcoin?
Cool. Did the property investing answer account for risks such as the property not being tenanted, tenant risk, etc.? I'm leaning towards shares as a lower maintenance option. Okay. But I can't give you personalized advice. Yep, we take all of those risks into account when we're looking at investment properties. But some people just aren't comfortable with it because of the perceived risk or the real risk. So if shares is your preferred option, then that's your choice.
Yeah, and one thing I would just say in terms of that is, so there is risk with property. There is also a risk not being invested into property. So the only thing I would encourage you to do before you decide that, you should understand the potential cost. There's cost both ways, but you just want to make an informed decision instead of an emotional decision.
Yeah. It's very difficult when we get those questions on this kind of forum to give any meaningful answer, because I'm instantly jumping into personalized advice. What are the pros and cons of investing in Simplicity from your professional perspectives?
Simplicity is like a really good, like low cost fund. We actually had Sam Stubbs, the founder, come on to do a couple of podcast episodes with them, and I really enjoyed them. Mike?
Yeah, same. Seems like a pretty reasonable person with a pretty clear mission, and he is gung-ho about making sure he hits it.
Yeah. Next one. Is there a website that clearly shows how your KiwiSaver is performing against others / average? This is very funny, Mike, because we just had the head of the personal finance lead from Sorted on the podcast yesterday.
Sorted.co.nz, great tool. Get on there, compares everything.
And if you can't find it on sorted.co.nz, try sorted.org.nz.
Sorted.org.nz. When it comes to savings, is there any income percentage goal you guys recommend, or depends on each case? Depends on each case. If you're a single mum with 2 kids living on your own, your savings percentage is going to be very different to a 20-year-old who's just got into the market, lives at home with his parents or her parents, and is earning about a bit of cash. It is all case by case.
Cool. Next one. What is income protection? So there is ACC that you would get paid for if you had an accident. Income protection is if you are sick and you can't go to work. So you have cancer, you've had some other sort of maybe a mental health. There's a reason you can't work for a long period of time. That would pay you a percentage of your income. I do strongly recommend that everybody who is not financially free has income protection. Now, it can be expensive depending on your income and your age. My response would be you can, pull levers to reduce the cost of the income protection.
What would you comment about Always Ethical KiwiSaver provider, their performance, credibility, etc.?
Well, in terms of credibility, probably not a great start, because I actually don't know who they are. So I really can't comment whatsoever. I assume they're quite new.
I've never heard of them, yeah. Where can I learn more about income protection insurance and how much I might need?
You could talk to an insurance advisor. So there is a conflict of interest with insurance advisors. The more they give you, the more they get paid, and they know a lot more about insurance than you do. So you do need to be quite careful. I would like to think our insurance advisors manage those conflicts of interest really well by using independent tools. So have a chat to one of our team. Shares and properties have been mentioned as an investment option. Are there any other suggestions for potential investments, such as classic cars or artwork?
I mean, yeah, like absolutely. You're just, it's the risk, right? We don't know. I don't know anything about classic cars.
Can
I know a little bit about art, not a lot about art. Yeah, go on.
Yeah. No, just no. Like, there's no need to do it. Like, people just overcomplicate their financial situations so much. Just look, really, it's just shares and property. They are the two investment. Of course, you got like bonds and property funds and all that kind of stuff. But really, and then if you own a business, that's just more income. Just keep it nice and simple. Don't overcomplicate your financial position. If you have spent 20 years in the car industry, or you know a lot about art, Mike spent $100 on a brick online. That was a piece of art. Funnily enough, just a brick turned up.
Two bricks.
Yeah.
Original
So
crown moon from bricks.
make sure you've got more kind of knowledge than Mike in the space.
Do you still recommend investment property in Auckland, lower yield, higher capital gain, or invest in other cities, better cash flow? This is a personalized financial advice question. Book in to see me. I will tell you exactly what I recommend for your situation. Depends on your cash flow, age and stage, what you're looking for, your property portfolio, what is out there in the market in terms of stock. We recommend people invest all over the country, depending on what they're looking for in their situation. I cannot answer that on this call.
Oh, next one. To choose a managed fund, I heard low fee options are best. Is that true? If you've got a small amount of money and you're investing into a low cost fund that is well diversified, I certainly think that is a good option. If you have a larger amount of money, I mean, obviously I'm biased on the subject, but I think paying for advice does make a lot of sense, but does depend.
I'm planning on upgrading my home, have a look at turning my first home into an investment property. Are there any tax benefits to selling the first home or buying the second home investment property? Would that not matter? I'm not an accountant. I can't give you advice on this. Very rarely does your initial investment property owner occupied property make a really good investment property. James kept his. James, how's yours performing?
Horrible. My goodness. Yeah. I do not make the mistakes I made. Learn from my mistakes.
I would say this is probably a great time to have a chat to a mortgage broker. We can look at the numbers, look at whether or not it's worth the transaction cost for selling. You might have a phenomenal house for renting out. But if I don't know what it is, I can't give advice on it. But generally speaking, try not to focus on the tax and focus on is it a great investment property? Yeah.
Cool. Okay, I am respectful of our room booking system, and we have come to the hour, so we will wrap it up there. What we will do is we will take all of these remaining questions and put it into a podcast. So make sure to subscribe to the podcast, and we will answer the rest of these questions. Please make sure to fill out the survey that will pop up. We will send links out to recordings, all sorts of information out to you, and make sure to check out our next webinar, which I'm not sure when it's coming up, but I'm sure it'll be coming up soon.